What if I told you that some billionaires have paid less in taxes than you? Not a lower percentage, less money. In some years, people worth tens of billions of dollars paid zero in federal income tax, zero. And no, they didn't cheat. They didn't break the law, and they didn't hide money offshore either. They just understand the system better than anybody else. Because in America, there are actually two completely different tax systems. One for people who work for money, and the other for people who own things. And once you see the difference, you cannot unsee it. Now today, I'm going to show you exactly how it works. It's a strategy used by people like Jeff Bezos, Elon Musk, Warren Buffett, and it's 100% legal. And it's been hiding in plain sight for decades. And it has a name: buy, borrow, die. And by the end of this video, you'll understand not just how they do it, but how you can start using the same principles even if you're not a billionaire. Let's break it down. Now, before I explain the strategy, I need to give you a quick crash course on how taxes actually work in America, because most of us learned about taxes through our paychecks, and that's the worst possible way to build wealth. See, when you work in a job, whether you're earning 50 grand a year or 500 grand a year, you pay income tax on every dollar you earn. And the government takes their cut before you even see your paychecks. So at the top, that's 37% federal income tax, plus state tax, plus Social Security and Medicare. When you add it all up, many working Americans hand over 40 to 50 cents of every dollar they earn to the government. But here's the secret the wealthy figured out. The US taxes income, and the ultra wealthy don't earn income the way you and I do. Think about it this way. If you own a stock in a company, let's say you own a stock in Amazon, and that stock goes from $1,000 to $3,000. Have you earned income? In your mind, yes. Your net worth went up by $2,000. But in the eyes of the IRS, no. You haven't earned anything, not until you sell that stock. And this is the concept of unrealized gains. Your stock can go up by billions of dollars, and the IRS cannot touch it because you haven't sold anything, so there's nothing to tax. Now, this is the fundamental difference between how working people build wealth and how billionaires build wealth. Working people trade time for money. They earn wages. Wages get taxed heavily. Wealthy people let assets grow. They own stocks, real estate, businesses, etc. And those assets go up in value. But until they sell, they own nothing. And smart billionaires never sell, which is exactly where buy, borrow, die comes in. All right, let's talk about step one, which is buy. The first thing wealthy people do is buy appreciating assets. That means assets whose value goes up over time, and this includes stocks and equity in companies, real estate, private businesses, art and collectibles, and venture capital investments. Now, the goal is really simple. You're building a portfolio of things that go up in value. And here's the crucial rule. You buy and hold. You don't sell. You never sell if you can help it. Let me give you the most famous example of this, Warren Buffett. Warren Buffett from Berkshire Hathaway. He has held Berkshire Hathaway stock for decades. And in this case, he literally built the company, and he has held onto his shares this entire time, watching them grow from pennies to hundreds of thousands of dollars per share. And here's the incredible thing. According to ProPublica's data, between 2015 and 2018, Buffett reported taxable income of somewhere between $11 million and $25 million per year. And that might sound like a lot, but Buffett is worth over $100 billion today. At least 14,000 ordinary American taxpayers reported more income than Warren Buffett did in 2015. How? Because most of Warren Buffett's wealth is sitting in Berkshire Hathaway stock. He doesn't sell it. It just grows. And growing assets are not income. Now let's talk about Jeff Bezos. Bezos, of course, built Amazon into one of the most valuable companies on earth. His wealth? Mostly tied up in Amazon stock. And he doesn't take a huge salary. And between 2014 and 2018, while his wealth grew by $99 billion, yep, that's right, $99 billion, his reported taxable income was $4.22 billion. That means less than 5% of his actual economic gains were even visible to the IRS in a form that they could tax. Elon Musk, same story. Tesla stock, SpaceX equity. These are assets. They go up, but Musk doesn't sell, he holds. Larry Ellison, the founder of Oracle, is worth over $200 billion. And much of that is in Oracle stock he's held for decades. And he's pledged over $4 billion of his Oracle shares as collateral for other ventures. But notice, he's pledging, not selling. Now here's why the buy phase is so powerful. Not only do these assets grow tax-free year after year, but there's another benefit: capital gains tax rates. Now, if you do eventually sell a long-term investment, something you've held for over a year, you pay capital gains taxes. That rate is 0%, 15%, or 20% depending on your income. And compare that to the 37% top rate on earned income. Just by owning assets instead of earning wages, you're already in a dramatically better tax position. But the real magic? Wealthy people have figured out they may never have to sell, which brings us to step number 2. And this is the part that makes people's jaws drop. And this is where the real tax avoidance happens. So step 2 is borrow. And here's the key insight. Borrowed money is not taxable income. The IRS does not consider a loan to be income. This is really important. So when you take out a mortgage to buy a house, you don't pay taxes on the loan proceeds. And when a bank gives you a car loan, you don't pay taxes on that money. It's debt, not income. So here's what ultra-wealthy people do. They borrow money using their assets as collateral. Think about it this way. You have $100 million in stock, and you need $10 million in cash, maybe, I don't know, to buy a yacht or a private jet or invest in another company. So you got 2 options, eh? The first option is sell $10 million worth of stock. You'll owe capital gains taxes, maybe $2 million or more, depending on how long your cost basis is. And you lose the future gains on those shares too. The second option, walk into a bank, let's say JP Morgan Private Bank or Goldman Sachs, and you say this: I have $100 million in stock. I would like to borrow $10 million against it. And the bank says, great, we'll charge you a couple percent in interest. Here's your $10 million. You pay 0 taxes on the $10 million. 0. Because it's a loan, it's not income. And this instrument is called a securities-based line of credit, or SBLOC. And it's sometimes called a pledged asset line, or PAL. And big banks like JP Morgan, Wells Fargo, and Goldman Sachs will typically lend you between 50 and 90% of your portfolio's value at very favorable interest rates. And the wealthy also do this with real estate. Let's say you own a $10 million commercial property. You do a cash out refinance. You borrow $7 million against it. You get $7 million in cash. You owe 0 taxes. You still own the building, and you still collect rent. Now here's where it gets brilliant. Because your portfolio keeps growing, you can just keep borrowing against it. You might borrow year after year to fund your lifestyle, vacations, real estate, other investments, and never sell a single share of stock, meaning never trigger a single capital gains event. Let me give you some specific examples. Elon Musk made headlines when he bought Twitter for $44 billion. Now, part of his financing plan involved pledging approximately $62.5 billion in Tesla shares as collateral to secure a $12.5 billion margin loan. He also ultimately sold over $20 billion in Tesla stock to fund the equity portion of the deal. But the principle is the same. His Tesla holdings are the engine behind everything. He doesn't just spend money, he leverages assets. That's crucial. And Larry Ellison did this in a big way. He pledged more than $4 billion of Oracle stock as collateral to fund his various ventures, meaning his real estate empire, his America's Cup racing team, and his philanthropic pledges, all without selling his Oracle shares and triggering a massive capital gain. And Jeff Bezos, even though much of his liquid spending comes from occasional structured stock sales, he has used his Amazon holdings as a foundation for his enormous leverage. The whole reason he can take risks, invest in Blue Origin, the Washington Post, and countless other ventures is because of the fortress of Amazon stock behind him. Now you might be thinking, well, wait a second here. You have to pay the loan back eventually, right? Well, yes, but here's the beauty of that strategy. You don't pay it back with cash. You pay it back by borrowing more. Or, as we'll see in step 3, the loan gets paid off at death, meaning the assets that have never been taxed. Now, there's one risk here I have to be honest about. This strategy can blow up spectacularly if the market crashes and your assets lose value dramatically. Bill Hwang is the most famous cautionary tale of this. He ran a family office called Archegos Capital, and he used enormous leverage borrowed against his stock positions massively. In March of 2021, when some of his positions collapsed, he lost $20 billion in essentially 2 days, all because of over leverage in a falling market forces margin calls. So the borrowing step works beautifully in a bull market and for diversified portfolios. But it can destroy you if you're over leveraged in concentrated volatile positions. Keep that in mind, please. But for sophisticated diversified billionaires, the math works extraordinarily well. You see, if your portfolio is growing at 10% per year and you're borrowing at 3% interest, you're netting 7% growth while living entirely off borrowed money and paying zero income tax. Now, this is the part that sounds morbid, but stay with me here, please. Because this is where the strategy becomes a complete elegant loop that can transfer generational wealth without ever triggering a tax bill. Step 3, die. Yes, the strategy literally depends on death, and here's why. When you die and leave assets to your heirs, something magical happens in the United States tax code. It's called the stepped-up basis. And here's how it works. Let's say I bought Amazon stock back in 1997 at $2 a share, and today that stock is worth a couple $100 a share. Okay, let's say it's $180 for fun. If I sell it, I pay capital gains on the difference, meaning $178 per share. That's a massive tax bill. But if I hold that stock until I die and leave it to my children's cost basis steps up to the value on the day I died. So if the stock is $180 when I die, their basis is $180. If they sell it the next day for $180, they owe zero capital gains tax. All those decades of gains untaxed, gone, permanently erased. This is the die part of buy, borrow, die. You hold the assets your entire life. You borrow against them to fund your lifestyle tax-free. And when you die, the step-up basis wipes out all of the embedded capital gains that were never taxed. And your heirs inherit the assets at full market value. Then they sell them, pay off whatever loans you had, and keep the rest, all without a capital gains bill. Now, let me paint a picture of how this works at scale. Imagine a billionaire has $10 billion in stock that he bought for $100 million decades ago. So his unrealized gain is $9.9 billion. In his lifetime, he borrows $200 million a year against the portfolio to fund his lifestyle. Zero taxes on any of that. Then he dies. His heirs receive the $10 billion portfolio, and their basis is stepped up to $10 billion. They sell enough stock to pay off the accumulated loans, let's say $2 billion. Then they keep $8 billion. Capital gains taxes owed on any of this? Zero. Now, what about estate taxes? The federal estate tax is 40% on estates above the exemption threshold. That's a real tax. But, and this is a big but, the very wealthy have entire teams of estate planning lawyers who use trusts, family limited partnerships, GRATs, meaning grantor retained annuity trusts, and charitable vehicles to dramatically reduce or eliminate estate taxes as well. And that's a whole separate video, and I'll make it. But just know that the wealthy have answers for the real estate tax question as well. Let me now bring all of this together with some real numbers so you can really feel the scale of what we're talking about. From 2014 to 2018, the 25 wealthiest Americans saw their collective net worth increase by $401 billion. That's an almost incomprehensible amount of wealth creation. Now, on that $401 billion, they paid $13.6 billion in federal income taxes. And that's a true tax rate of 3.4%. And for comparison, if you're a middle-class American earning 60 grand a year, you're probably paying somewhere between 20 and 30% of your income in combined federal, state, and payroll taxes. And your effective tax rate is potentially 10 times higher than some of the wealthiest people on earth. Now, here are some individual numbers from ProPublica's report. Jeff Bezos. His wealth grew by $99 billion from 2014 to 2018, and he paid only $973 million in taxes. So his true tax rate is less than 1%. And in 2007, 2011, he paid nothing. Elon Musk. During that same 5-year period, his wealth grew by $13.9 billion. He paid $455 million in taxes, so his true tax rate was 3.27%. And in 2018, he paid zero federal income tax. Warren Buffett, his famous Buffett rule, he said publicly that it's wrong that he pays a lower tax rate than his secretary. His true tax rate over that period was just 0.1%. Now, his wealth grew by $24.3 billion, but he paid just $23.7 million in federal income taxes because he never sold his Berkshire stock. Michael Bloomberg, his true tax rate of 1.3%. He has paid zero federal income taxes several times in recent years by using charitable contributions and other deductions to offset his tax bill. George Soros, he paid zero federal income taxes for 3 consecutive years. And it's not just stocks. Peter Thiel, the PayPal co-founder and early investor in Facebook, used a Roth IRA intended to help middle-class people save for retirement. And he did that to grow what started out as about $1,700 to over $5 billion completely tax-free. He put his early-stage PayPal shares into the Roth IRA when they were valued at nearly nothing. And when those shares exploded in value, all those gains were sheltered inside the account. And withdrawals after age 59 and a half are entirely tax-free. Steve Ballmer, the former Microsoft CEO, he bought the Los Angeles Clippers. A sports team purchase creates enormous tax deductions through depreciation of player contracts and other assets. It allowed him to dramatically cut his taxable income. Now, I know what you're thinking. Chris, this all sounds great for billionaires. What about me? Well, here's the honest answer. You can use versions of this strategy, and many people already do without even realizing it. Let's start with real estate, because this is the most accessible version of buy, borrow, die for regular people. If you own a home and it's gone up in value, congratulations. You're already in phase 1 of this strategy. You have an appreciating asset, and you can borrow against it. And that's what a home equity line of credit is, or HELOC. You borrow against your home's equity, you pay no taxes on that money. And if you own investment properties like I humbly do, a rental duplex, a small apartment building, you can do cash out refinances to access equity without selling. You still own the property. You still collect rent. You owe no taxes on the cash you pulled out. And for investors with brokerage accounts, many brokerages now offer margin loans or security-backed line of credits. Fidelity, Schwab, Vanguard, they will lend out against your portfolio. Now, the minimum portfolio size varies, but some lenders will work with portfolios as small as $100,000. Goldman Sachs and JP Morgan cater to the ultra-wealthy with extremely favorable rates. But don't overlook what's available to you at a regular brokerage. Now, the step up in basis applies to everyone, not just billionaires. If you have a stock portfolio, a rental property, or a business, and you plan to leave it to your kids, holding rather than selling can be a major estate planning advantage. Now, Here's my very simple framework for regular investors. Step 1, start building appreciating assets now. Max out your 401k and IRA. Buy index funds and hold them. If you can afford it, buy real estate. Build a portfolio of assets that grow. Step 2, stop thinking of your portfolio as something to sell when you need cash. Instead, think of it as collateral. Before you liquidate investments, ask your brokerage if you can borrow against them. And step 3, I want you to think long-term. I want you to think generationally. The step up in basis is one of the most powerful estate planning tools available to everyone. Think about what you want to pass on and structure your assets accordingly. Now let's talk about the risks. I got to be completely transparent. The borrow step creates real debt. If your portfolio drops significantly, you could face margin calls. And real estate loans can turn toxic in a downturn. And you also need the portfolio to keep growing faster than the interest you're paying. And this strategy works beautifully in long-running bull markets, which is exactly the environment billionaires have enjoyed for the past several decades. But in a prolonged bear market, it gets really complicated. And I'd be doing you a disservice if I didn't tell you that this strategy is incredibly controversial, and there are real efforts to change it. For example, Senator Ron Wyden of Oregon introduced what he calls the Billionaire Income Tax Act. And this would tax the unrealized gains of billionaires on an annual basis, meaning you'd owe taxes on your stock gains even if you haven't sold. And this would essentially eliminate the foundation of buy, borrow, die. And a while back, President Biden proposed taxing unrealized capital gains for households worth over $100 million. And that proposal went nowhere, but the pressure to close this loophole or tax advantage, depending on your perspective, is real and growing. And the Yale Budget Lab has done detailed analysis of potential reforms specifically targeting the borrowing phase. For example, treating loan proceeds as a deemed realization of capital gains for the wealthiest borrower. Now, none of these reforms have passed as of right now, but the political pressure is building, especially as wealth inequality data becomes more widely understood. And the step-up basis in particular is something that many tax experts across the political spectrum consider to be difficult to justify. It is potentially the single largest tax advantage in the American tax code that most people have never heard of. So there it is. Buy, borrow, die. Buy appreciating assets, stocks, real estate, businesses, and hold them. Borrow against those assets to fund your lifestyle without triggering a single taxable event. Die with those assets. Pass them on to your heirs with a stepped-up basis and erase all those capital gains forever. Jeff Bezos, Elon Musk, Warren Buffett, Larry Ellison, Michael Bloomberg, they didn't just get rich through hard work and smart investments. They got rich and stayed rich because they understood that in America, how you earn money matters just as much as how much you earn. Now, the tax code has been written, whether intentionally or not, in a way that massively favors asset owners over wage earners. And understanding that isn't cynicism, it's literacy. So please take this knowledge. Start applying the principles where you can. Build assets, hold them, borrow against them intelligently, and think generationally. And as always, if you found this valuable, please hit that subscribe button and share this video with someone who needs to hear it. Drop your questions in the comments below. And I also do a live office hours every Thursday at 8 a.m. Pacific time right here on this YouTube channel. And I'd love to answer your questions in real time. I'm Haroun. Go build your wealth. I'll see you in the next one. Thank you.